Hey guys, did you know that in retirement there's something called an RMD where at a certain age, right now that age is 73, you have to take a certain amount of money out because the IRS wants to get paid on all that tax deferred money. So for many people this throws a real wrench into their retirement plan. Maybe they don't need the income, maybe they get pushed into a higher tax bracket, and so it can create a real problem. And of course the IRS wants to get paid, so that is what it is. However, there are some solutions, and I wanted to introduce one today where one of our whole life experts, Denise Boisvert, has helped clients basically to channel those RMDs into a premium for a properly designed high cash value whole life policy. And the reason you might do this doesn't change the RMD impact, but what it would do is create a legacy plan where those proceeds are being funneled into something else with guaranteed growth, tax advantages, and a lot of other living benefits, which we often talk about on our channel. So Denise has worked with hundreds of people and had decades of experience working on these kinds of strategies. So I wanted to just talk about this actual experience she had with the client setting this up and how it worked out well for the client. So let's listen to Denise, and then I'm going to jump back in with you, give you some key action steps to take. So let's jump in. Denise?
Welcome everyone. This is Denise Boisvert, Pro Client Guide for InsuranceandEstates.com. Just wanted to show you a concept today that would allow you to leave as a legacy the full amount of your IRA accounts and not have them be dwindled down by the taxes due on those funds. So as you may know, the majority of Americans today have the bulk of their retirement funds in qualified accounts, such as IRAs, 401ks, SEPs. As you know, taxes need to be paid on those accounts when withdrawn. It's also a well-known fact that most people do not need their required minimum distributions or their RMDs. But at the age of 73, the IRS mandates that you must start withdrawing a percentage of your account annually so they can start collecting some taxes. It's pretty much inescapable. So what if you took those net RMD distributions that you didn't really need in the first place and deposit them into a whole life policy that is structured to maximize the cash value? What this would allow you to do is a couple of things. Most importantly, pass along your full amount of your IRAs, create a tax-free death benefit that will cover all of the taxes on your IRA balances, leave not only your full IRA value, but also a tax-free death benefit to your family, have a tax-free liquidity of the cash value in your whole life policy in case of an emergency, and also have a long-term care component should you need care down the road. Let me just show you what this looks like. So if we have an account, our IRA has $500,000. That can be one account, that could be all of our accounts added together. We're at age 73 and we need to start taking distributions. Our RMD is going to be $18,868, and that RMD amount that we have to take out each year grows annually because the percentage increases as you get older. If we use, let's just say, a 20% tax bracket on that $18,868, you're going to be paying around $3,700 of taxes, which leaves you a net of $15,094. This net each and every year would be put into your life policy. By doing that on the life policy, you will see that the amount you're depositing is the same as what's on your RMD schedule. Immediately, that gives you a $203,000 tax-free death benefit. This policy is structured to hold around $23,000 a year. So basically to age 84, 85. If you have longevity in your family, we can make this longer. We build it to whatever you want. This is just an example. So at age 84, let's assume you pass away. You would have $181,202 of cash value in your whole life policy, plus a death benefit of $293. The balance on your IRA is $457,863. So that would be taxable. So those taxes equal around $89,000. So we're going to pay the taxes on this account out of your life insurance, out of that $293,590. So we pay the $89,000, and you still have 200-something thousand worth of tax-free death benefit, plus your value of your RMD account, your IRA account. So you're close to $600,000. You started out at $500, and now you have a full tax-free death benefit to your family to leave as a legacy of over $600,000. This is the cash value that grows along with your contract. So this amount of money is available to you during your lifetime if you need it. If you have an emergency, it's your money. But the goal is to try to keep it in there to be able to have, and like as you can see, you have plenty to pay your taxes. So you could probably borrow in here, and it probably wouldn't affect the outcome of your account. So that's basically it. You're just taking your net RMDs, you're throwing them into a whole life policy. This policy is based on standard rating, age 73, but you can see the dynamic impact this would have on your family, where they don't have to be burdened on paying taxes on your IRA and they receive the whole thing. Hope this helps. Hope this concept is attractive to you. Please reach out to me. There's a link below that you can contact me directly, and I'd be happy to design a plan specifically for your needs.
All right, well, thanks, Denise. That was fantastic. Just an idea for you guys. If you're interested in looking at this further, there are 3 things you can do right now. You can pull out your retirement account, think about when your RMDs are going to be required. You could email Denise any questions at Denise@InsuranceandEstates.com, and that'll be posted wherever you're watching this video. Finally, you could schedule a one-to-one on Denise's calendar if this or any other strategy sounds interesting to you related to high cash value whole life. As always, guys, we appreciate you. Thanks for joining us. Like, subscribe, and leave any comments to this video. We really want to hear what you think, and any questions you may have. We do respond to the comments. Thanks so much.